Hello, listener. Let us today know about what is shell company and what is shelf company. First, let us know what is shell company. According to FATF, a company that at the time of incorporation has no significant assets or operations can be termed as shell company or shell corporation. Shell companies can be set up in onshore as well as offshore locations, and their ownership structures can be taken in several forms. Shares can be issued to a natural or legal persons or in registered or bearer form. Some companies can be created for a single purpose or to hold a single asset. Another type of shell company can be established as multi-purpose entities. Shell companies are often legally incorporated and registered by the criminal organization, but have no legitimate business, often possessed of the shell form by the lawyers, accountants, or secretarial companies. They are convenient vehicles to launder money. Sometimes the stock of these shell corporation is issued in bearer shares, which means that whoever carries them is the purported owner. Tax havens countries and their strict secrecy laws can further conceal the true ownership of shell corporation. In addition, the information may be held by professionals who claim secrecy. FATF, in a report in 2001 titled Money Laundering in Canada, an analysis of RCMP cases, offered 4 related reasons to establish or control a shell company for money laundering purposes are followings. 1. Shell companies accomplish the objective of converting the cash proceeds of crime into alternative assets. 2. Through the use of shell companies, the launderer can create perception that illicit funds have been generated from a legitimate source. Once a shell company is established, commercial accounts can be created at banks or other financial institutions. Especially attractive to money launderers are businesses that customarily handle a high volume of cash transactions, such as retail stores, restaurants, bars, video arcades, gas stations, or food markets. Illicit revenues can then be deposited into bank accounts as legitimate revenue, either alone or commingled with revenue legitimately produced from the businesses. 3. Once a shell company is established, a wide range of legitimate or other bogus businesses transactions can be used to further the laundering process. These include lending money between criminally controlled firms, paying out fictitious expenses or salaries, disguising the transfer of illicit funds under the guise of payment for goods or services, or purchasing real estate with the proceeds of crime, or disguising payments for real estate as mortgage issued by the shell company. Shell companies can also be effective in concealing criminal ownership. Nominees can be used as owners, directors, officers, or shareholders. Companies in one country can be incorporated as subsidiaries of corporation based in another country, especially a tax haven country, with strict secrecy and disclosure of laws, thereby greatly inhibiting investigations into their ownership. Shell companies can also be used to hide criminal ownership in assets by registering these assets, such as real estate, in the name of the company. The Canadian report mentions the following money laundering techniques used in connection with criminally controlled companies. First, using nominees as owner or directors. To distance a company from its criminal connections, nominees will be used as company owners, officers, and directors. Nominees will often, but not necessarily, have no criminal record. Further, companies established by lawyers will often registered in the lawyer's name. Second, layering. In some cases, a number of companies are established, many of them connected through a complex hierarchy of ownership. This helps to control criminal ownership and facilitate the transfer of illicit funds between companies, muddying any paper trail. Third, loans. Process of crime can be laundered by lending money between criminally controlled companies. In one case, a drug trafficker had $5,000 in a bank account in the name of a shell company. These funds were lent to a restaurant in which the drug trafficker had invested. The seemingly legitimate use of the funds assisted in making it appear that the funds were being properly integrated into the company. The $5,000 was repaid with interest to avoid suspicion. Fourth, fictitious business expenses or false invoicing. Once a criminal enterprise controls corporate entities in different jurisdictions, it can employ a laundering technique known as double invoicing. An offshore corporation orders goods from its subsidiary in another country, and the payment is sent in full of the bank account of the subsidiary. Both companies are owned by the criminal enterprise, and the payment for goods is actually a repatriation of illicit money previously spirited but of the country. Fifth, sale of business. When the criminal sells the business, he has a legitimate source of capital. Sixth, buying a company already owned by criminal enterprise. An effective laundering technique is to purchase a company already owned by criminal enterprise. This laundering method is most frequently used to repatriate illicit money that was previously secreted to a foreign tax havens. Seventh, paying out fictitious salaries. In addition to claiming the proceeds of crime as legitimate business revenue, criminally controlled companies also help make certain participants in a criminal conspiracy appear to be legitimate by providing them with salaries. Let us now know a shelf company. According to FATF, a corporation that has had no activity and has been created and put on shelf is a shelf company. This company or corporation is then later sold to someone who prepares a previously registered corporation over a new one and thus hide the original entity. In October 2006, FATF issued a report called The Misuse of Corporate Vehicles, including Trust and Company Services Providers. In this report, FATF said that of particular concern was the case with which the corporate vehicles can be created and dissolved in some jurisdictions. It allows these vehicles to be used not only for legitimate purpose, such as business finance, mergers and acquisitions, or state and tax planning, but also by those involved in the financial crime to conceal the source of funds while keeping their ownership concealed. Thank you for watching the video. Please subscribe to our channel and keep connected.